City Summerlin, Las Vegas's most famous retirement community, is sitting on a reserve fund that its own financial analysis says is less than half of what it needs. More than 7,000 homeowners, a $30 million gap, and a $5,000 bill that hits every single buyer at the door. That is what the brochure did not show you, and it is only the beginning of the story. The promise was simple. Nevada does not tax your income, and more of your retirement stays in your pocket. What the brochures left out was the other bill, the one that arrives every single month, goes up every single year, and in the worst cases, lands in your mailbox as a 5-figure surprise with a 30-day deadline. The Vegas tax break is real. But for retirees living inside Summerlin, Henderson, and Sun City, those savings can quietly vanish, swallowed by a system of fees, rules, and reserve fund obligations that rivals any state tax they ever paid. Stick with me as we break down 7 specific reasons this trap works so well. From the hidden layered fees most buyers don't see until closing, to a reserve fund crisis hitting one of Las Vegas's biggest 55-plus communities right now, to the legal fine print that makes leaving more expensive than staying. Part 1. The tax arbitrage illusion. The promise that brought them here. Nevada's pitch is real. The state of Nevada does not impose a state income tax on individuals. That is the official position of the Nevada Department of Taxation, confirmed in writing. For a retiree leaving California, where state income tax can hit 13% at the top, or Illinois, Oregon, or Minnesota, states that take a meaningful cut of every pension check, every Social Security dollar, every IRA withdrawal, this matters enormously. A household pulling $70,000 a year in retirement could be saving $3,000 to $5,000 annually, sometimes more for households with higher retirement income, simply by changing their state of residence. And Las Vegas offered something else on top of that. Master-planned retirement living at a price that felt impossible back home. Summerlin, Henderson, Sun City. Communities with trails, pools, fitness centers, and the kind of organized neighborhood life that retirement brochures have been selling since the 1970s. For a couple in their early 60s selling a California home, the math looked incredible. But, and this deserves its own pause, the math on paper is not the math on the ground. Because what almost nobody calculated before signing the purchase agreement was the full cost of community living inside these gates. Not just the mortgage, not just utilities, the HOA fees. And not just one fee. In many Las Vegas master-planned neighborhoods, buyers walk into a layered fee structure that the developer built decades ago, and that the community now cannot escape. The tax savings is real. The community costs are also real, and for thousands of retirees now on fixed incomes, the arithmetic has stopped adding up the way they expected. Part 2. The layered fee structure. The hidden bill nobody warned them about. Here is the mechanic that catches buyers completely off guard, and it is the detail that agents, even well-meaning ones, often fail to make clear enough before closing. In Summerlin and Henderson, many homes sit inside multiple HOA structures simultaneously. Not one association, not one monthly fee, 2, sometimes 3, stacked on top of each other, billing separately, increasing independently. The structure works like this. A master association governs the broader community. Shared trails, major parks, community-wide amenities. Then a sub-association governs your specific neighborhood cluster, the immediate pool, the street-level landscaping, the neighborhood commons. You buy the house, You join both. You pay both every single month. As of January 1st, 2026, Summerlin North homeowners pay $74 per month to the Master Association. Summerlin South pays $76. Summerlin West pays $69. But that master fee is not the whole bill. Typical sub-association fees run an additional $50 to $150 per month on top. Stack the numbers, and you are looking at $119 to $226 per month total, or $1,428 to $2,712 per year just in HOA fees before a single special assessment ever arrives. Move to Henderson's Seven Hills community, and the numbers climb further. Local real estate guides report figures ranging from $150 to over $500 per month, or potentially $6,000 plus per year, depending on sub-association. City Summerlin runs at $208 per month, $2,496 annually, and townhome owners may face a second fee on top of that. Nobody marketed this community as no state income tax, plus a private tax of up to $2,000 a year. The brochure made the no income tax benefit feel like pure savings. What the layered fee structure turned it into was a trade. A trade most retirees did not realize they were making. Part 3. The Special Assessment Time Bomb. The bill that arrives without warning. What we've described so far is the predictable cost, the monthly fees a careful buyer can find if they ask the right questions. But there is another category of HOA billing that works differently. You cannot budget for it, because the HOA does not tell you it is coming until it is already decided. This is the special assessment. And in Nevada, the rules around when your HOA can issue one are worth understanding before you sign anything. Under Nevada Revised Statute 116.3115, HOA boards can levy special assessments for necessary and reasonable common expenses. A homeowner vote is only required if the assessment exceeds 25% of the prior year's total budget, or $500 per unit, whichever is less. Read that again. If the assessment is $500 or under per unit, the board passes it without a homeowner vote. They send you the notice, you pay the bill. You have 21 days advance written notice, and then the money is due. $500 does not sound catastrophic in isolation, but when reserve funds are underfunded, and we are about to get to exactly how underfunded some of the largest Las Vegas HOAs actually are, these assessments can come in waves. A structural repair, a roof replacement, a pool resurfacing, each one under the vote threshold, each one legally levied without your approval. And Nevada requires pending special assessments to be disclosed in the resale package, which means a looming assessment does not just hit your wallet, it can damage your ability to sell at the exact moment you need out most. Part 4. The Reserve Fund Scandal. What happens when the money is gone? Special assessments do not appear from nowhere. They are almost always downstream of one upstream failure, a reserve fund that was never properly maintained, or, in documented cases, the subject of criminal allegations filed with state regulators. And in Las Vegas, this is not theoretical. On September 10, 2024, a public comment submitted to Nevada regulators described Boca Raton Condominium Community Association as the third major HOA scandal in the Las Vegas Valley in 20 years. The allegation, submitted in a public filing to Nevada regulators, $11 million disappeared from the HOA Reserve Fund. The homeowners who had been paying their dues faithfully for years were then handed the bill. The documented special assessment amounts per unit: $3,868, $5,477, or $7,583. Homeowner Benjamin Weeb said it directly to Nevada regulators. Homeowners like us have been left holding the bag. And then came the line that deserves to be in every retirement planning conversation. The bag is that $11 million was taken from our HOA. That is a public record filing, not hyperbole, not opinion. A submission to state regulators. The Community Associations Institute, industry reserve specialists widely benchmark a healthy HOA reserve fund at a minimum of 70% funded. The threshold most reserve study professionals and property managers use to define financial stability. At Boca Raton, after the alleged misappropriation, residents were not sitting at 70%. They were sitting at whatever was left, and then receiving five-figure assessments to cover the gap. Corporations argue that reserve fund failures are the exception, that most HOAs manage finances responsibly, that Boca Raton was an outlier, and that is fair, to a point. But even without criminal misconduct, reserve underfunding is a structural problem across American HOA communities. Nevada's own regulatory framework has not prevented communities from running dangerously low. Which brings us to the case that is not historical. The one happening right now. Part 5. City Summerlin, the retiree dream. With a $30 million hole. City Summerlin was built by Del Webb, the company that invented the 55-plus retirement community concept in America, starting in Arizona in 1960. Pulte Group, one of the country's largest home builders, now carries that legacy. They built it, they sold it, they collected the revenue, and today, the community Del Webb marketed as the retirement dream is sitting on a reserve fund, its own formal reserve study. A financial analysis required under Nevada law says is less than half of what it needs. More than 7,000 homes, decades of community life, and as of May 2025, a reserve fund holding just $18.2 million against a shortfall the community's own numbers put at $30 million. The words from reporting were blunt. This indicates that our reserve account is 45% funded, not 90%, not 70%, 45% of what the community itself said it needed. What does that mean? It means when City Summerlin's aging infrastructure needs major repairs, and infrastructure always needs major repairs as it ages, the money may not be there. And when it is not there, the bill goes somewhere. It goes to the homeowners. Monthly dues run $208 per month, $2,496 per year. That is the number buyers see. But every resale transaction also carries the New Owner Reserve Assessment, NORA, a one-time charge at closing, now sitting at $5,000, raised significantly from its earlier level of roughly $1,900. You pay $5,000 before you spend a single night there. Then, $208 a month, inside a community whose own reserve study says it is less than half funded. From where a retiree on a fixed income is standing, staring at that $30 million gap, the brochure feels very far away. Part 6. The Rules Trap. Trading tax freedom for permission slips. Set the dollar amounts aside for a moment, because the financial costs are only part of what retirees traded when they moved inside these gates. The other cost is autonomy. And in retirement, after decades of following somebody else's rules at work, losing the right to make basic decisions about your own home hits differently than people expect. Parking. Many Las Vegas HOAs prohibit overnight street parking entirely, restrict vehicle storage, and control which vehicles can park in front of which homes. Park the wrong vehicle in the wrong place too many nights, and a fine notice appears in your mailbox. Garage use. One Las Vegas community made local news. The HOA ruled garages could not be used solely for storage. The fine? $100 per week until compliance. Rentals. CC&Rs in both Las Vegas and Henderson, HO, as flag rental restrictions as a major buyer review item. Some communities limit short-term rentals. Others require board approval before you can rent at all. If your plan involved renting the home part of the year to offset the HOA fees, the HOA may have already decided that plan is not permitted. Architectural controls. Want to change your front door? Replace the landscaping? You submit a request, you wait, and the committee can deny it entirely. Non-compliance triggers fines, forced reversal at your expense. Nobody put this in the brochure. You are not just buying a house. You are joining an organization with the legal authority to fine you, lien your property, and pursue action if you do not comply. For retirees who moved to Las Vegas to feel free, that is a very particular kind of irony. Part 7. The can't leave equation. Why exiting costs more than staying. This is where the can't leave part of the title stops being a metaphor and becomes math. When a retiree decides to sell, because the fees became unmanageable, an assessment hit too hard, or life simply changed, they run into exit costs the purchase side brochure never mentioned. First, the NORA. City Summerlin's new owner reserve assessment sits at $5,000 at closing. But here is what that means for the seller. A $5,000 NORA is a cost every buyer factors into their offer. Your effective sale price drops to compensate. The market already did the math for you, and it did not do it in your favor. Second, Nevada's resale disclosure law. Any pending special assessment must appear in the resale package. Every buyer sees it. Every buyer's agent talks them through it. And when your community is sitting on a $30 million reserve shortfall, that information follows every listing. The negotiation that follows is not in the seller's favor. Third, timing. Retirees who moved in their early 60s often find by their mid-70s that the community's aging infrastructure and their own changing needs are colliding at exactly the same moment. The reserve stress peaks as buildings age, the assessment risk climbs, and the buyers they're trying to reach are now researching HOA financials more carefully than any generation before them. The NORA at City Summerlin started at roughly $1,839 in earlier filings. It reached $5,000 by the 2025 guide. Nearly tripled, applying at every transaction. Every time this community changes hands, the cost of entry goes up, and the seller absorbs that reality in the price they accept. This is the lock-in, not a locked door, a financial architecture built into these communities decades ago that makes every exit more expensive than the one before it. The reality of Las Vegas. HOA living is more complicated than either side wants to admit. Summerlin is genuinely beautiful. Sun City's trails are real. The community events are real. None of that is manufactured. And for many residents, the value is absolutely there. But the full cost picture, Layered fees, special assessment risk, reserve fund vulnerability, restriction enforcement, exit complications. That picture was not in the brochure. And for retirees making a once-in-a-lifetime financial decision, not in the brochure is not an acceptable standard. Nevada's no-income tax promise saves a household $3,000 to $5,000 a year, sometimes more. But when layered HOA fees in a community like Seven Hills can run to $6,000 plus on their own, before a single assessment, the tax savings stops being a windfall and starts being a wash. These problems are not permanent. HOA boards that mismanage reserves face consequences. Nevada's Real Estate Division Ombudsman process exists for exactly these disputes. The market will self-correct. But for the retirees already inside the gate, already on fixed incomes, already staring at a 45% funded reserve fund, or a $5,000 exit fee sitting between them and their next chapter, eventually is not a comfort. What they needed was the full picture before they moved. And most of them did not get it. If you are currently researching Las Vegas retirement communities, and based on the comments from our last video, a lot of you are, drop it below. Did the HOA fees surprise you when you started digging into the actual disclosures? Was the layered fee structure something your agent walked you through, or did you find it yourself? Your real experience is worth more than any brochure, and it helps every other pre-retiree here make a better decision. Hit the like button if this video showed you something you hadn't seen before, and subscribe to Flick. We dig into the real numbers behind Las Vegas living every single week.